The broadcast is now starting. All attendees are in listen-only mode.
Welcome and good afternoon. My name is Amy O'Hara and I'm a partner at Littman Krooks. Our firm focuses in the areas of special needs planning, guardianship, special education advocacy, trust and estates, and elder law. Today I'm going to talk about what the latest is on the ABLE Act, what the ABLE Act is, and what we can expect in the coming months. So what is ABLE? ABLE is Achieving a Better Life Experience Act. It's an account that's tax-advantaged savings account that an eligible individual can use to save funds for qualified disability-related expenses of the account's designated beneficiary. And I'll explain in a little while, in a couple slides, what qualified disability-related expenses are and who qualifies as a designated beneficiary. The importance is that these accounts will still allow the designated beneficiary or the account owner to maintain eligibility for often much needed government benefits, including Supplemental Security Income, also known as SSI, Medicaid, and most recently SNAP. That's our food stamps program, who recently announced that the ABLE accounts will not cause any loss of benefits under their program, provided all of the requisite ABLE rules are followed. What these ABLE accounts will do will allow individuals who have disabilities to have greater independence and control, and not limited to whatever their means-tested benefits are, that they can't have more than $2,000 in their name. So just a little history and update on how this act came about and where we are now. So the ABLE Act added Section 529A to the Internal Revenue Code. Many of us are familiar with 529 accounts, which are college savings accounts. So this adds a Section A to that section in the Internal Revenue Code. The act was signed by President Obama in December 19, 2014. We are currently waiting for regulations to be issued by the IRS. Proposed regulations were issued in June of 2015 for comment, and the final regulations have not yet been issued. We were expecting them in the spring of 2017. My office recently spoke with the contacts at the IRS, and they were expecting it to still be spring 2017. However, the Trump administration has recently froze any new regulations to be issued pending their review and approval of them. And regulations are really, what the purpose behind them is, it's going to provide guidance and rules to carry out the ABLE law. And it will also assist the states who are have the ABLE programs with following the rules correctly. Also, importantly for recipients of SSI, the Social Security Administration issued guidance in October of last year. And it's really internal guidance, but special needs lawyers often rely on this guidance, to know how the Social Security will administer the program. Look at the program; they're not administering it, but look at the program and how it will impact an individual's SSI. Now, states have an option of whether to want to create an ABLE program. They do not have to create an ABLE program. Currently, as of January 9th, and I don't think it's changed since then, 10 states have ABLE programs: Alaska, Florida, Kentucky, Michigan, Nebraska, Ohio, Oregon, Rhode Island, Tennessee, and Virginia. You see, New York's not on that list yet. So unfortunately, in New York, we still cannot open up an ABLE account. Governor Cuomo in December of 2015 signed the ABLE Savings Account Act. It became effective April 1st of last year, but it's still held up in the state comptroller's office. We're hoping, their website said that they were expecting it for us to be able to have access to the ABLE program by the end of 2016. Now they say, the website says in 2017. And just to note, because I know that there's different information out there, but you can, so if a state does not have an ABLE program, they are permitted to, beneficiaries are permitted, or the states can contract with other states to join their account, similar to some 529 college savings plans. In New York, because we are going to have ABLE accounts, we're not going to be able to join other states. So we're waiting. Now in the beginning, I mentioned that an ABLE account can be opened for somebody who qualifies as a designated beneficiary. Well, who is a designated beneficiary? It's an individual who has to meet a couple requirements. Is entitled, so the individual needs to be entitled to benefits based upon a disability or blindness under the Social Security rules, meaning that they qualify for SSI or Social Security disability insurance. And there's different eligibility requirements for those programs, which is beyond the scope of today's webinar. But so if a person receives SSI or SSDI based upon their disability, then they can be considered a designated beneficiary if they meet the other requirements. If the person is not entitled to SSI or SSDI for some limited reason, for a reason, most people are, but sometimes they're not, they need to submit certification that meets the criteria for a disability. So what does that mean? And this is still part of the regulations that are being worked out with the IRS. But however, the IRS issued guidance several months ago saying that it's going to be a certification signed under the penalties of perjury that the person has a signed doctor's, physician's diagnosis that they are disabled, and it will be retained and provided to an ABLE program or the IRS if requested. Now, coupled with this certification or the eligibility for the SSI or SSDI, it is critical to understand that the person, in order to be a designated beneficiary, the individual has to have been disabled before the age of 26. Okay? The disability must have occurred before the age of 26. If it happens, if the disability occurred, the diagnosis occurred age 26 or later, then this program is not open to those individuals. Now, this is not when the account can be opened. Somebody who's 45 years old or 55 years old who became disabled before the age of 26 can certainly join, open up an ABLE account when we're able to in New York, but it's just that the disability has to have occurred before then. So ABLE accounts are, as I mentioned before, they're going to allow some freedom and control by an individual who, for example, if they're receiving SSI, as many of us know, they're not able to have more than $2,000 of assets total, not including exempt assets, but $2,000 in, let's say, a checking account. Otherwise, they lose eligibility for SSI. So this ABLE account with certain restrictions, which I'll go over, will allow them to have more than $2,000. The contributions and the earnings are not counted as income or assets to the designated beneficiary, meaning that any earnings on the account are not going to be taxed to the beneficiary. When somebody makes a contribution, that's not taxed to the beneficiary. Okay, the account owner must be the designated beneficiary. Okay, so what does this mean? You say, Amy, you know what, I understand that, but my child doesn't have the capability of joining an ABLE account. Well, a person, if the child had previously signed a power of attorney, or the parent or a legal guardian can be the signatory and establish the account on behalf of the designated beneficiary, if they're unable to do it themselves. Any person, including the beneficiary himself or herself, can contribute to the ABLE account. The person includes family members or friends. Also, the IRS defines person to include trusts, estates, corporations are allowed to contribute to this account as well. So if a beneficiary has a special needs trust, for example, the trust can actually contribute to the ABLE account to provide for some, resources above the $2,000 for the beneficiary if the beneficiary, for example, is on SSI. It is very important to know that only one ABLE account is permitted per beneficiary. So it's important to coordinate. If you have other family members that may want to do the right thing and open up an ABLE account for a grandchild, it's just very, communication is very important. The second account or the third account, any account over the first account that was established will not be exempt, okay? And it will not be considered qualified as an ABLE account. So there are limitations on what can be contributed to the ABLE account. In any given year, we're limited to the gift tax exclusion amount. So what that means is in 2017, assuming that we're able to open up an ABLE account in New York, we are not going to be able to contribute more than $14,000 a year to the account. That's total. So if the beneficiary may have some extra money that he wasn't able to spend from SSI or SSD or earnings, and he contributes $3,000, and grandma contributes $1,000, and you as the parent want to contribute to this account, then you cannot contribute more than $10,000 to this account. The states are, under the proposed regulations, the state, so New York State is supposed to be implementing safeguards so that these accounts do not accidentally get funded over $14,000, but we haven't seen how that's going to play out yet. The $14,000 also does not include earnings. So if you contribute $14,000 to the account, but there was $3,000 of earnings on the account, that's not counted towards that $14,000. It's just actual contributions into the account. In New York, we're limited as the account grows, and this won't be a problem for many, many, many years, but the account will, once the account reaches $375,000 in assets or in value, there can no longer be any contributions made to the account. Okay, similar, and that's a 529 rule as well. So if any of us have 529 plans for children, that same rule applies as well. However, and this is very important because many of our loved ones receive SSI, if the designated beneficiary receives SSI, then the account cannot exceed $100,000, so you can no longer contribute to the account. So if the account has $100,000 in it, you are no longer able to make contributions to the account, but it doesn't prevent the account from having earnings. So if the earnings put the account over $100,000, that's okay. Now, it's important to consider, so for somebody, for a beneficiary who is receiving SSI, if they have their checking account where their monthly SSI check is deposited, let's say they have $1,500 in that account, that they have $1,500, and the ABLE account all of a sudden is, it goes over, and I apologize before, I should have, it does include earnings over the $100,000. So we don't want the $100,000 to go over. The account becomes $101,000, that grossed in value to $101,000. That because you have to combine the beneficiary's own assets in his bank account, which says $1,500 and then $101,000, so that's $102,500. That puts the person over by $500. Okay, so you want to just be cautious that it's coordinating the beneficiary's own personal account, not non-exempt asset, as well as this ABLE account. Contributions must be cash. So when you make a contribution to the account, it has to be cash. It can't be appreciated stocks or real estate or anything like that. It is a completed gift of the present interest, so it does count as an annual exclusion gift. If, and I haven't, in the next couple slides, I'll be talking about what qualified disability expenses are, but if a distribution is made for something other than a qualified disability expense, there will be a 10% surtax or penalty tax on that distribution to the designated beneficiary, plus any taxable income on the growth. So if there was $14,000 in the account and it grew, that was contributed in it, and it grew to, you know, $20,000, let's say the account wasn't used over the years, that $6,000, there's a calculation that they'll apply, and that $6,000, and there's a ratio that they'll apply to income and earnings, and how to include that taxable income in the beneficiary's income taxes. Now, is that a big deal? You know what? It may not be a big deal because so a lot of times the beneficiary doesn't have a lot of income where any type of 10% surtax or the taxable income, you know, included in the beneficiary's, you know, tax basis is going to be minimal. Well, you know, it's a case-by-case basis. Now, what are qualified disability expenses, and that, which is what, you know, how the ABLE account can be used for? And, you know, they're defined to include expenses incurred that relate to the disability of the designated beneficiary and are for the benefit of the designated beneficiary in maintaining or improving his or her health, independence, or quality of life. Okay, so you'll see that in these lists of expenses are not, you know, they're not limited to this. There may be further regulations down the road, or as this program is implemented, we'll see how, you know, what other expenses can fall as, you know, be treated as qualified disability expenses. But so far, this is how the IRS, through regulations, and the Social Security Administration has provided that housing expenses, which is very big because, as we all know, for SSI purposes, if a parent or a grandparent or a trust or any individual pays for food or housing expenses, it causes a 1/3 reduction in that benefit, in the SSI benefit. Well, if the ABLE account pays for the housing expenses, the Social Security Administration has issued guidance saying that it will not result in a 1/3 reduction of the SSI benefit. So that's really important. Education, transportation, employment training support, assistive technology and related services. One note there, and the IRS gave an example that, you know, let's say a person has a developmental disability with severe limitations on their ability to communicate and navigate. A smartphone is okay and can be counted as a qualified disability expense because it will help the individual communicate and navigate his or her way. Legal fees, financial and management fees, expenses for ABLE account oversight, funeral and burial expenses, which again can be important for some families because there are certain types of first-party special needs trusts, for example, where if the funeral and burial was not prepaid, then the trust is not able to pay for it upon the beneficiary's death. Here, it looks like even upon the designated beneficiary's death, that we will still be able to use the account to pay for funeral and burial expenses, even if they were not prepaid, before Medicaid may have a payback, which I'll talk about soon, and basic living expenses. And I know that that's generic, but that's how the regulations are set forth. So again, the phone, for example, that's an example, and we'll see some more examples as this rolls out. Can you roll over an ABLE account? Okay. So when and what this means is when the beneficiary dies, when the designated beneficiary dies, if there's money remaining in the account, It can be rolled over in limited circumstances. It can only be rolled over if a family member who also qualifies as the designated beneficiaries. But these family members are limited to siblings, step-siblings, and half-siblings by blood or adoption. Okay, so that's not going to apply to most of our beneficiaries. So if you cannot roll over the account when the beneficiary dies and money remains in the account, then it's important for you to understand that there's a Medicaid payback when the beneficiary dies. So when so it'll be the account, the amounts remaining in the account will be subject to a payback for any Medicaid paid on behalf of the beneficiary after the date of the establishment of the account. So what that means is if the account was established on July 1st of 2017 and prior to that date the beneficiary Medicaid paid on behalf of the beneficiary $100,000 so far during the beneficiary's lifetime, and then after the account was established, the beneficiary used another $50,000 worth of Medicaid benefits during his lifetime. Well, when the beneficiary dies, Medicaid is limited to recouping only $50,000 from the account. Now, let's say there's only $14,000 in the account, okay, because it was just established and we can't put more than $14,000 into the account during the year. Well, then Medicaid is only able to get $14,000 back. If Medicaid's, if they only paid $5,000 on the beneficiary's behalf since the account was established, and there was $14,000 in the account, now there's $9,000 left over. And that would go to the beneficiary's estate. This, and unlike some issues with first-party special needs trusts that we experience from time to time, if there are still reimbursable expenses to be paid for qualified disability expenses such as funeral and burial and final qualified disability expenses, those can actually be paid before Medicaid gets paid back. Now, it's important, though, because anybody can contribute to this ABLE account, so it includes third-party contributions, not just what the beneficiary contributed to the account, but what anybody contributed to the account. So, and today's presentation is really not going to go into the ins and outs of special needs trusts. If that's something you're interested in having a webinar on a future presentation, let me know, and I'll be happy to focus a webinar solely on special needs trusts. But just basically speaking, there are two main types of special needs trusts, and they're first-party and third-party special needs trusts. Sometimes they're referred to as supplemental needs trusts, and I know we have pool trusts as well, but for purposes of today's presentation, a first-party special needs trust is a trust that's funded with the beneficiary's own assets. And a third-party special needs trust is a trust that's funded with other people's money for the benefit of the beneficiary, but it's not funded with the beneficiary's own assets. And so the next couple slides, I just want to compare the differences between the ABLE accounts and the special needs trust. Now, it's important to know that they can work together, but an ABLE account is to not replace a special needs trust, particularly for estate planning. Okay, and these are some of the reasons why. The maximum annual contribution you can make to an ABLE account is $14,000, whereas special needs trusts have no contribution limits. We're limited to one ABLE account per beneficiary, whereas a beneficiary can have multiple special needs trusts. I have some clients that may have a first-party special needs trust and even sometimes a couple third-party special needs trusts that maybe different family members may have established throughout the years. If the beneficiary has SSI, the account cannot have more than $100,000 in it. And that's obviously not true with special needs trusts. Special needs trusts have no limit on the amount of money that can be in the trust. For our third-party special needs trust, when the beneficiary dies, there is no Medicaid payback, which is not the case with ABLE accounts. So if an ABLE account is created and funded or contributed solely by family members, it's just important to understand that that account could be subject to Medicaid payback upon death. Another situation is if the beneficiary became disabled after the age of 26, then you cannot establish a special needs, you cannot establish an ABLE account, but you could establish a special needs trust really for at any age, with the exception of a first-party special needs trust, which we have a limited we can't establish it for somebody who's 65 or older. But aside from that, there's really no age restriction with special needs trusts. So what can go wrong with ABLE accounts? Well, you know, and again, you've heard me say this, that the third-party money can be exposed to payback to Medicaid, accidentally setting up multiple accounts, accumulating over $100,000. And what about undue influence? Some of the beneficiaries may be subject to undue influence. We don't know yet what regulations and requirements New York State is going to be putting in place to account for how these funds are being, these qualified disability expenses are being tracked. And it's just something to be mindful for our capable, more capable beneficiaries that may be able to manage this account on their own, but if they're subject to, outside influences that are not positive. Now, I told you some negatives, but what about when to consider ABLE? Even with the understanding that there's some Medicaid payback, I think it will go a long way for capable beneficiaries so that they have some autonomy in decision making in their life. That yes, we may have an account funded, with significant, it could be a significant amount of money, or 10, 20, 30, if not more $1,000, but it sometimes gives beneficiaries a sense of worth, and that's important. And other reasons to consider is that if the beneficiary has unspent earnings through, let's say, Social Security, that they start accumulating too much over the 2000, they can't spend it. We usually don't have that problem, but from time to time we have that problem. If they do have some limited work, and we may have some Medicaid excess or surplus income issues that we need to be mindful of. We could put that extra money into the ABLE account. Again, it cannot exceed $14,000. If there's an inheritance received, and that's a $14,000 on a calendar year, so you could put in $14,000 in December of 2017, and then January 2018 put in another $14,000, but then that's it for the rest of the year until 2019. If there's a small litigation settlement, and I get this frequently from clients who have these custodial accounts that they didn't think about until we get close to having the child apply for SSI, and now they realize the child has too much money to qualify for SSI, and this ABLE account can be used to fund custodial accounts. Another thing, and this even goes back up to my first bullet point, is a distribution from a special needs trust. So if the beneficiary is a beneficiary of a special needs trust as well, but we try to get some spending money that can be used for qualified disability expenses, then the trustee of the trust can put money into an ABLE account for the beneficiary to use. And I'll just spend a minute on this slide so that you have a chance to look at it. But this basically shows the differences between assets in an individual's own name, a third-party trust, a first-party trust, and then the ABLE account, and the different rules there. So I'll just let you look at that for a minute, because I've really covered all of this in my prior slides. Okay, what's next? All right, well, first and foremost, hopefully soon we'll be able to open up an ABLE account in New York State. As I mentioned before, it's still with the State Comptroller's Office. I don't have any really new updates for you. On the next slide, I'll be giving you a website that you could certainly check for updates from New York State. And once we have the rules and regulations from New York State, and this gets up and running, I perhaps may have another webinar so that we could have more of the nuts and bolts of, okay, how do we open up this account? You know, what are the reporting requirements? What you know, how's everything accounted for? You know, all the ins and outs and intricacies of implementing and using an ABLE account. The IRS, we're waiting to issue final regulations. Again, they were saying that they're expecting them in spring 2017, but I anticipate it could be longer. We'll have to wait and see. New laws. So in the 114th Congress, which their term just ended at the end of last year, there were 3 bills pending. They all died in the previous Congress, so I don't know if they're going to be reintroduced, but it'll give you a sense of that our some of our congressional people and senators are, you know, through lobbying that we're doing is try to, you know, allow different amendments to this ABLE. And these are just, so here's 3 that were there. Again, I don't know if they're going to be reintroduced, but it shows a couple things that they were going to try. We were trying to raise the age limit to 46. So from 26, where the onset of the disability occurred before 26, now to 46. The Financial Planning Act. So doing planning for families from time to time, I'll have clients come to me who where they've smartly created 529 accounts for all their children, and it, you know, turns out that one of their children will likely not be able to use the 529 account, and now they have all of this money in the account. Where there was a bill pending that you know, would allow you to take the money from the 529 account, college savings account, and put it into an ABLE account. You know, again, that didn't go anywhere. And then the last one was the Able to Work Act, which allowed beneficiaries to have, if they had certain work earnings, and it was only about $11,000 a year, but you could add that in addition to the $14,000 to the account. So it could be $14,000 plus it was a little more than $11,000, and so that, you know, extra work earnings that you could put into the account. Here, and I'll stay a minute on this slide as well, additional resources, the ARC of USA. It talks about all 50 states. Some states are not implementing the ABLE program. Some states are allowing individuals in their state to join other states. The ABLE, so that gives you an update on where where the states stand. The ABLE National Resource Center, and that just gives you overview of what happens with the ABLE Act, any news or any new laws that may be pending, and that's a good reference site. In the Office of New York State Comptroller, and that gives you updates on what the program is and where it stands. So I'll just stay one more minute on this slide here, in case anybody's writing it down. And actually, I'll stay at this slide because I'm at the end. So if you missed any part of this presentation or would like to review the slides available, I know there will be a replay available in the coming days. So just keep track of at our website at www.littmankrooks.com and for further updates and to review the materials. Now I'll open it up to any questions that there may be. And so I'll just give a minute because I know my staff will be sending some questions to me, if there are any. Oh, no questions. Okay. All right. Well, thank you very much. There's no questions right now. And we'll be ending this, and I thank you so much for joining.